So to break it down, the private market universe, it's a fairly rich universe. It's been evolving very fast. The private market world as we know it is actually essentially born after the 40s, I would call it like this. Biggest chunks are private real estate, a bit of infra, and a bit of oil and gas.
Hi everyone, and welcome back to TheCapitalNet TV. I'm Apoorva, and today with TheCapitalNet TV, we bring to you a very intensive and a very indulgent series which is revolving around the private market. Today, we have with us an industry expert, Mr. Cyril Demaria, who essentially is going to break down the private markets for you. Can we also understand how this entire industry is structured, as in who are the key industry players in each of these asset class, and what are their roles and what do they bring to the table in such a scenario?
Sure. So there are probably three big players or actors in the scene. You have the fund investors. The fund investors are the ones who have the capital, and the fund investors want to achieve specific goals. They would be tempted to do it themselves, but to do what I described earlier is already fairly challenging, and to do it at a global scale is technically almost impossible. You would need resources which are probably not available to anyone in the world at the moment. So the investors then decided to team up, as I said, and then to delegate to a specialist the management of their capital. The investors are usually passive. We don't ask their opinion. So once it's delegated, they should trust the person to whom they delegated the management of their capital. That's a little bit where it starts to get a little bit scary, because when you delegate, you have a strategy, but you don't really know where they're going to invest. There is no Bloomberg in this environment. There is no database where you could say, oh, within 6 months, the capital is invested and I know the 2025 holdings I'm going to invest in. So that shifts the focus then on the fund manager. The fund manager is really someone who is supposed to be specialized. The level of specialization can vary, but it's very unusual that you would find a fund manager would invest in all industries globally. It's possible, but you need very, very large teams. And normally each team then would be at least a local specialist. So you have this big corporation, and then they have local offices, and maybe they have a global fund which is allocated opportunistically depending on the strategies. The fund manager is compensated by the fund being the capital pot in which the investors have put their money, okay? And so the fund manager is actually an advisor. Technically, it's also a fund investor. They have to put a little bit of their money in the fund to try to foster the alignment of interest between the fund investors and the fund managers. But they're compensated through a stream of fees, notably management fees, but also performance fees, so that they can achieve a specific target in terms of returns, which is jointly designed by the fund manager and the fund investors. So the fund manager basically sets up the strategy, writes the documents, knocks at the door of the fund investors, and then the fund investors say, okay, that's interesting. Can you change a little bit this and a little bit that? And then they sign the paper, and the fund manager does the investments for them. And then, of course, monitors the investments and divests. Which leads me to the investments, which is the third category of factors I was referring to. The investments are local. You need to spend a fair amount of time to search for them. And basically, the effort of the fund manager is to qualify the opportunity, to check everything, check the risks, identify the source of value creation, and ultimately do the investment, monitor it, eventually control how it goes and change things, and then ultimately sell it at a profit. This is the three categories of factors. And in between, there is the fund which is the pivot of the relationship between these actors. That's how it works.
That's very true, and it's very collaborative in the way how the essentially fund investor and the managers play in order to in a way to deploy the money that is going into the market. What we're essentially going to look at right now, Cyril, is I think the viewers would be very interested to know what sort of is the investment life cycle for these different asset classes, right? Like there is a different way the fundraising goes till the exiting of the investment, and each asset class has its own unique investment life cycle. So if you can tell the viewers a little bit about that.
Yes, with pleasure. It's true that there are some variations. What is common, let's start with that, is that normally the fund manager has to collect the capital, and this is called the fundraising period. So that's when they knock at the doors of the fund investors, and the fund investors think about it, ask questions, look at what happened in the past, and then they ask, can you reproduce the same type of investment going forward with hopefully the same level of success and performance, knowing that this can change, obviously. So it's not that easy to assess for the fund investors, who once again are not the specialists. So they need to get in the world of the fund manager and understand how it works. Now, once the capital has been collected, then there is what we would call a period of investment for the fund. And this is the part which can vary. So for example, in some strategies, it would be, for example, 3 years. In others, it might be 2. In others, it might be 5. I would say the more, the riskier the investment strategy is, the longer the investment period would be probably. So in senior direct lending, you would have normally 2 years where you would deploy the capital. In infrastructure, it varies, but it can be 3 years, maybe to some extent, maybe 5. But in strategies like venture capital, you would have a 5-year investment period. And the reason for that is because since the strategy is already quite challenging, because you're financing companies which are startups, so cash flow negative, very young, very sensitive to a lot of factors, very risky, then what you want is to diversify the risk also over time, because there is also a valuation risk. You don't want to invest at the top of a cycle and then discover that you made the right choices, but somehow you overpaid for it systematically. So if you have 5 years, normally it helps you to smoothen a little bit the valuation excesses and invest at lower or comparatively lower or higher valuation. That's the investment period. And then you rightfully pointed out that there might be discrepancies in the time we hold the assets. So for example, you would observe that in growth equity, we tend to hold the assets around 3 to 4 years statistically in the portfolio, whereas in the venture world, it's a little bit closer to 5. And then if you hold infrastructure, it's around 7 to 8. If you hold Timberland, it's also 7 to 8. So the holding period, the time you keep it in the portfolio varies depending on the asset and of course the type of investment strategy you apply to the company. Some take longer to be implemented, but also to show the result. And this is during what you would call the harvesting period, which is also known as the divestment period. And then the fund is finished, and then we don't do anything anymore. So that's a little bit the process. So one of the logical conclusions of that is that the fund managers have to regularly raise a new fund so that they don't run out of capital to deploy and they can continue to work.